Hello, traders. Let's address a question from the audience that relates to investing during risk-off market trends. The question goes as follows. During risk-off sentiment in financial markets, what Chinese government bonds do investors buy in their flight to safety? Well, during periods of risk-off sentiment in global financial markets, investors often rotate capital away from riskier assets and seek refuge in instruments perceived as safe and liquid. In the context of China, the government bond market has increasingly emerged as a viable destination for such flight to safety flows, particularly in the past decade, as the country's financial markets have opened up and gained global relevance. When risk aversion dominates, the most sought-after Chinese government securities are China government bonds, especially those with intermediate to long durations, typically in the 5 to 10 year range. These bonds are issued by the Ministry of Finance and are considered the Chinese sovereign benchmark, akin to U.S. Treasuries in their domestic context. CGBs are known for their relatively low default risk, deep liquidity in the secondary market, and predictable monetary policy backdrop, especially when the People's Bank of China is adopting a cautious or accommodative stance. From an international perspective, the attractiveness of Chinese government bonds during risk-off periods is also tied to their historically low correlation with developed market sovereign debt and their relatively high yields, even in times of global uncertainty. Foreign institutional investors, such as central banks, sovereign wealth funds, and asset managers are particularly drawn to CGBs because they offer diversification benefits while still being part of an economy with robust fiscal fundamentals. Moreover, investors sometimes favor policy bank bonds issued by China's three primary policy banks, that is the China Development Bank, the Agricultural Development Bank of China, and the Export-Import Bank of China. While these bonds are not sovereign in a strict legal sense, they are widely perceived as carrying implicit government backing and trade with yields slightly above those of CGBs. For yield-seeking investors who still wish to remain within the safer confines of quasi-government exposure, these bonds offer a practical alternative. It's important to note that the liquidity and safety premium tends to concentrate at the front and belly of the yield curve during pronounced risk-off episodes. Investors seeking capital preservation over yield often migrate towards shorter-dated CGBs, where price sensitivity to interest rate changes is reduced and reinvestment flexibility is enhanced. The 2- and 5-year maturities are frequently the sweet spot for institutions balancing risk and return during volatile macro conditions. Also worth discussing is the role of China's Bond Connect programs, such as the China Interbank Bond Market and the Bond Connect channel. These platforms have facilitated easier access for offshore investors, reinforcing the presence of Chinese sovereign debt as a legitimate safe haven asset class during global drawdowns. The inclusion of Chinese bonds in major global indices like the Bloomberg Barclays Global Aggregate Index has further boosted institutional comfort with allocating capital into this space. However, a flight to safety into Chinese government bonds is not without nuance. Currency risk plays a significant role in foreign investor decisions. The renminbi's stability, or lack thereof, can significantly influence the risk-adjusted return profile of holding CGBs. That said, in times when China's macroeconomic policies are perceived as more stable or counter-cyclical compared to Western economies, RMB-denominated assets gain favor for both safety and potential appreciation. To sum up, in risk-off climates, traders and institutional investors increasingly look to Chinese government bonds, particularly CGBs, in the 5 to 10 year range as a refuge for capital. The combination of perceived credit safety, relative yield advantage, and growing accessibility supports their role as a credible alternative in global portfolios. While these bonds may not yet rival the dollar's sanctuary status, they have firmly entered the conversation among global safe haven assets, especially for those seeking geographical and policy diversification. We will interact further in more such sessions. Thank you.